Hi there, welcome along to this Kaplan Masterclass on the cost of capital. My name is Andrew Mower. I'm a tutor at Kaplan in London. So the purpose of this video today is to hopefully give you a bit of an understanding as to what the cost of capital is. You might have seen it called the WACC just on the first screen there, which is the weighted average cost of capital. So looking at the same thing. So the first thing I want to do today is just make sure we're understanding what does it actually mean? And I think if you get that, then it makes it a lot easier when you're then trying to calculate it and work out all its components. Once we've done that, we'll then look at the three main costs that you need when you're working out the WACC, which is the cost of equity, the cost of debt, and the cost of preference shares, or KE, KD, and KP, as they're commonly known. And then what I've done is I've got 5 little practice questions. Now, these are sort of short form questions that you see in some qualifications. It may not be relevant for your qualification in terms of the exam style, but the little tricks that they put in these questions, I see in all the different qualifications that we do at Kaplan. So still really useful, all the little tricks, all the little tips when you're doing a WACC calculation that they love to throw in there. So we'll look at those 5 practice questions and I'll talk you through those. Okay, let's think about what the cost of capital actually is, first of all, then. So it's the average cost of a company's capital weighted by the proportion of each type of finance that they've got. So companies have different types of capital, by which we mean they might have some equity, they might have some debt, they might have some preference shares. And each one of those has its own cost associated with it. So it might be that equity tends to be the most expensive. So that might be costing them one amount. And then to hold the debt, they'll have to pay interest on their loans and all that sort of thing. And that might be a bit cheaper. And then all we're doing is taking an average of those costs. But rather than just saying, oh, we'll just add them all up and divide them by 3 or whatever, we'll weight them based on how much the company has of each type of finance. So as a quick example, let's imagine that we've got a company and they've got 70% equity, they've got 20% debt, and in this instance, it's redeemable debt specifically, and then they've got 10% preference shares. So that's what we call their capital structure. That's the makeup of the business. That's where they've got all their money and all their finance in the company. So same weightings, 10, 20, 70. But what I'm just going to do now is introduce the costs. So let's say that they've got 14% cost of equity. So that's sort of relating to their equity. We then got 8% debt is the cost of debt. And then we got the 10% is the cost of the preference shares. So each of those sources of capital have a different cost associated with them. Now, this is quite common in that the cost of equity is the most expensive. For investors, equity is the riskiest form of returns, and therefore, would expect a pretty high return on the cost of equity. Debt, on the other hand, for investors is the safest investment, and also companies get tax relief on that. So debt tends to be the cheapest for the company, and then preference shares often somewhere in the middle of the two. So here I've got 14%, 8%, and 10% are our 3 costs of capital, or cost of equity, cost of debt, cost of preference shares. Now, as I said a minute ago, what we then need to do is weight those based on how much we've got of each, because as I said, we could just add the 3 up, couldn't we? 14 plus 8 plus 10 and divide them by 3 and say, right, there's our average cost. But hopefully you can see from this, the little sort of pie chart thing, we've got a lot more equity than we have debt, for example, and a lot more equity than we have preference shares. So what we need to do is weight these costs based on the amount of finance we have of each. And that's where that name, the WACC, comes from, the weighted average cost of capital. It's weighted based on the proportions of each type of finance. So that's what we're going to do, is weight those. Now, when you're doing this calculation, you know the answer is going to be somewhere between 8 and 14 because that's the highest and the lowest cost. And because we've got a lot more equity, I'd expect it to be up towards that 14% mark. So it is going to be weighted up towards the 14%. So when we do this, and the way I like to do it is to do just the proportion of the finance times by the cost for each one. So there's our equity. So here's our equity element there. You've then got your redeemable debt there. So 20% times its cost. And then you've got your preference shares. So I'm just doing the weighting, for example, preference shares, 10% preference shares. And then the cost is 11%. So times by its cost. So they're your preference shares. And so we're just weighting each. And remember I said I'd expect it to be somewhere between 8 and 14, but slightly more towards that 14% because it's got the heaviest weighting. That 70% there is the heaviest weighting, isn't it? And if we do that, put it all in, into your calculator or the software, whatever you're using, you should get 12.5% is what the WACC is. So that is the company's average cost of holding all this money in the business. It costs them on average 12.5% a year. Now, companies then usually would use that as their discount rate when they're doing NPVs, or if they need to value parts of the business. That WACC is useful for all sorts. Because if you're doing a project now that gives you a 7% return, it's not going to be worth it, is it? It's costing us 12.5% just to hold all this money in the company. So if we then go and do a project that returns 7%, well, it's going to make us a loss. And therefore you end up with a negative NPV if you use that as the discount rate. So this is almost like the benchmark now. We need returns to be higher than 12.5% in this business. Otherwise, there's not going to be much point. So hopefully that helps you understand what the cost of capital is about, and sort of almost that final calculation as to how you piece it all together. What I want to look at now is how you work out these costs. So you've got this thing, the cost of equity, which we call KE here. You've got the cost of debt, KD, and then you've got the cost of preference shares, KP. And in the exam, you're very unlikely to be given those, as I have here, and just said, here you go, here's 14%. You're probably going to need to work those out. So I'm just going to run through a quick overview of how you calculate each of these. And then, as I said, we've got some practice questions to look at as well. Okay, so KE, using the dividend valuation model, first of all. So this is KE, the cost of equity, and there are two ways of doing this. You can either use the dividend valuation model, or it's sometimes called the dividend growth model, which is based on this formula here, and it's all using dividends and what we expect dividends to do in the future. There's another method called CAPM, which we'll look at in just a sec. But for now, let's focus on this DVM, the dividend valuation model. So here is the formula you need. Often given to you in most qualifications we teach, you get given that, but you might just want to check your formula sheet to make sure it is given. You've got D0, which is your current dividend that you put in there. You've got P0, which is your current, what we call ex-div share price. Now that's the share price after the dividend's been paid. So if ever they say, here's the share price before the dividend's been paid, that's what we call a cum-div share price, and you need to take one dividend off that. So if ever it says there's a dividend about to be paid, or the dividend hasn't been paid yet, what we're going to need to do is just take off one dividend from the share price. We always want this ex-div share price, which is the share price without that dividend attached, and we want to remove that dividend. And then G is your estimated growth in dividends as a percentage. So these two will either be in the top two, D0 and P0, will either be in cents or dollars or pounds or pence, depending on which qualification you're doing. And then G, that will be a percentage. So that'll be your estimated growth in dividends as a percentage. Just make sure D0 and P0 are in the same units when you're doing this. So if you are using dollars, make sure they're both in dollars, or if you're using cents, make sure they're both cents. You can't put one in dollars and one in cents, because otherwise everything will get messed up. So we'll look at how to use that when we do a practice question at the end of this video. But just to make you aware, you can also rearrange this formula, which then gives you this formula here. So same variables going in, but just a rearrangement of that. And that allows you to value one share. So if you know the company's cost of equity, you can actually work out the share price from that. So that's quite a useful one as well, to work out the share price. So the top one is used to work out the cost of equity if you already know the share price. And the bottom one, again, just flip round, allows you to value a share if you know what the cost of equity is instead. Right, the second way of finding the cost of equity, so still looking at KE, is using this thing, CAPM, the capital asset pricing model. So you got a little formula here. RF is your risk-free rate. That's the return you'd get if your investment had no risk whatsoever. Now that is often, they'll say treasury bills or government bonds or something like that. They're often assumed to be risk-free. So if ever you see the treasury bills are currently return 3%, that's going to be your RF figure. You've then got beta, the equity beta that you put into there. Now that's the adjustment depending on the company's level of risk. Now, if your beta is 1, you are perfectly average risk. If it's 0, you are no risk at all. If it's more than 1, you're riskier than average. If it's less than 1, you're safer than average. And all it's doing is just adjusting the returns we need to pay our shareholders. So if beta is more than 1, what that tells us is we need to pay our shareholders more than average. So it's just a little adjustment depending on the risk of the business. And beta is made up of a couple of things: the industry the company's in, and also their level of gearing, the amount of debt they've got. But that's something that goes into a little bit more detail, which we won't go into now. You've then got RM, which is the average market returns. So if you're an average company with a beta of 1, that's what you'd expect them to pay their shareholders. And RM minus RF, that little bracket there, is called the risk premium. And in some questions, they'll give you the risk premium rather than the RM figure. So just read the question carefully as to which one they've given you. Okay, so that's CAPM. That's the other way of finding the cost of equity. Again, you often get given that formula, but just check with your specific exam as to whether you get given that one or not, or whether you need to remember it. And we then move on to KD, which is the cost of debt. Now, it depends on the type of debt as to how you're going to work out the cost of debt. If it's irredeemable, you just use that little formula, interest divided by the market value. If it's redeemable, you need to do an IRR calculation using the market value, the interest, and the redemption amount. I'll show you how to do that on the next slide. If it's convertible debt, that's where at the end, in the redemption year, you either take cash or you take some shares, and you always choose the higher of the two things. So again, I'll show you that in just a sec. And if it's a bank loan, you just use whatever the bank rate is. That will be the yield. Now, all of those are pre-tax. So what that means is this is the percentage return to an investor, is what you're working out at the moment. If you want to work out the cost to the company, because interest is tax deductible, what we see is the cost to the company, you then have to do the yield times by 1 minus the tax rate. So just take tax off that, and that will give you the cost to the company. And that's what you want to be using in the WACC, is this post-tax one. So just make sure you're clear with that. This is the return to investors, but the cost to the company, they get tax relief. So you just times it by 1 minus the tax rate to get that. Now, let's just look at that redeemable debt, this IRR calculation. A lot of qualifications now allow you to use software, and there is an IRR function. So it works quite nicely. And you can use this in Excel or Google Sheets, or various different software sort of setups you can use to do this, and various different spreadsheets you can use to calculate this. So if you put in at year 0 your market value as a negative figure, so you put your number in there, and then you just have to do each year separately. So you do year 1 interest, year 2 interest, ... up until year N, which is the year of redemption. And in that final year, you put in your interest payment, because don't forget, you'll still get interest in that final year, plus your redemption amount. Now that there, if this is convertible debt, will be the higher of your cash and share value. So if it's convertible debt, that's where you put the higher of the two. If it's just redeemable debt, you just use the whatever the redemption amount is, it will tell you. You do need to add those two together in the final year to get that. You can't do them as separate lines, because then the software doesn't work. So you do need to add the two together. Now, what you then do is just do equals IRR. And if you select these cash flows, like so, and do equals IRR and just select those cash flows, that will then tell you the pre-tax cost of debt. So that's what the average percentage return to an investor is over the life of that bond. And don't forget, because we're looking from a company's perspective, we just then need to deduct tax. So times it by 1 minus T, and that'll give us the post-tax cost of debt. Finally, KP, the easiest of the three costs. You just do the preference dividend divided by the ex-div preference share price. So just that. We assume that they don't grow. They pay a constant annual dividend. So there's no need to worry about growth. It is actually, it is pretty much the same formula as the KE formula using DVM, but just without the G. So yes, it's a similar concept. And all we're saying is, look, if we get a 5p dividend and the shares are worth £1, that's going to be a 5% return. Companies don't get tax relief on preference dividends, so don't times it by 1 minus T. You just leave it like that and job done. So hopefully nice and straightforward. Okay, so that's all of the different costs: cost of equity, cost of debt, cost of preference shares. Just one more thing before we look at some practice questions. If you need to value a preference share, you can, again, just flip that formula around, which then gives you the value of the share. So again, just a rearrangement of that. If you needed to work out the value of a preference share, you should do D0 over KP, if you know what KP is. Right, let's have a look at 5 practice questions then. Bring this to life a little bit, hopefully, and see see what we get. So we've got here the ordinary shares of DS are quoted at $7.50 per share. A dividend of 60 cents per share is about to be paid. There's no growth. What's the cost of equity? And just be very careful if you're doing a qualification where you get questions like this and it says state it to 1 decimal place. If you do it to 2 or you do it to 0 decimal places, you won't get any marks. So just be careful. So when it says quoted at, that is going to be our share price. So that's going to be P0. But we're just going to need to be a bit careful with this. Then we've got the dividend of 60 cents. So that's our D0. And then there's no growth. So G is 0 effectively. The key thing that you've got to watch in this question is the fact that a dividend is about to be paid. That's the thing that that's the trick in this question that we just got to watch out for. Because what that tells us is that share price is what we call cum div. So because the dividend hasn't yet been paid, that share price still has that dividend attached. It still includes the potential of that dividend that's about to be paid. So to get the ex-div share price, so to get the ex-div P0, what we need to do is 750 minus 60 cents, which is 690. So that's our ex-div P0. So that's what we're going to use as P0 in our formula in the DVM. We've got D0, which is 60 cents. And G is 0, so we could just ignore G. So we're going to use that the DVM formula. Just to remind you, it's D0 times 1 plus G over P0 plus G. So we're going to be using that formula. Because there's no G in this question, we can just ignore that and that. So we can just say, right, forget those, and just do D0 over P0. Or you can put G as 0 and use the formula still, it works. So what we're going to end up with is just 60 over 690. Again, don't forget, we want this to 1 decimal place and just be consistent with your units. And we should end up with 8.7%. So that would be our cost of equity. Okay, so just to show you that one with the little trick around dividend about to be paid, the whole cum div thing. So you just got to watch out for that. As I say, they do love these little tricks just to make sure you really understand it. So just be careful with that. Okay, so that's our first question. The next one, we've got the cost of equity is 12.5%. They want the dividend per share that was paid out. So we're going to have to do a little bit of rearranging here. So you've got the cost of equity is 12.5%. Again, I'm a big fan of just labeling everything up as I see it. So that's KE, and the shares are currently quoted at 650. So that's P0. You might think, right, is that cum div or ex div? A dividend has recently been paid, so that's fine. That's without the dividend, so that's already ex div. So no need to adjust it. We're fine. Not the same trick as before. And then growth is in dividends is 4%. So that's our G. And then they say, right, the dividend per share that was paid out is, so that is D0 effectively that we're trying to find in this one. So we've now got KE, P0 and G, and we need to work out D0. So again, it's just a case of, yeah, they've given us maybe slightly backwards, maybe not quite how we expected it, but it's okay. We can do it. No problem. So if we think of that formula again, I'll just write it out just so you have it again. So I know most qualifications give you this formula, but you use it that much that you do start to remember it anyway. So if we just fill in the blanks, so we know 12.5% is D0, which we don't know, times 1 plus G, which is 4%. So 1 plus 4% over P0, which is 650, plus G, which is 4%. It's then just maths, isn't it? It's then just down to, right, we just need some maths to work out, to rearrange it. So if you take away 4% from both sides, we end up with what, 8.5% equals D0 times 1 plus 4% over 650. If you then times both sides by 650 to cancel that out, and then divide it by 1 plus 4%. Again, if you if you're okay with rearranging, this is then straightforward. If not, you might just need to go away and practice. But what I'm going to do, I want D naught on its own. This is what I'm trying to find. So what I'm going to do is times both sides by 650 to clear that over here. And then I'm going to divide it by 1 plus 4% to get that. So what we're going to end up with is D naught equals 8.5% times 650 divided by 1 plus 4%. And again, if you need a little recap of rearranging, there's plenty of resources available on my Kaplan and lots of other sort of platforms if you need to look at that. So if we look at, so do that times 650 divided by 1.04, we end up with 53 cents. It's actually 53.1, but, or 0.53 it comes out as, but that's absolutely fine. So there you go. So the answer would be A, 53 cents. If you don't like rearranging, a little bit of maybe an unconventional strategy, but what you could do is say, right, I know the answer is 12.5%. I'm going to try all 4 options as D naught in this formula and see which gives me 12.5%. And because it's A, it would actually be first attempt, wouldn't it? First try. You go, oh, okay, there you go. That gave me 12.5%. So you could just sort of do trial and error of the 4 options in there and see which one gives you 12.5% as your answer. But we've done it properly. So hopefully we're okay. Okay, on to the next question. ED has just paid a dividend of 10 cents per share. Their cost of equity is 15% and dividends are going to grow at 3%. What is the ex-div price of ED? So again, similar stuff in that's D naught and they just paid it. So we're all good. KE is 15%. And then we've got growth is 3%. And what they want us to do now is to work out the share price. So again, sort of similar setup in that you've got 3 of the 4 variables that you need. It's then just a case of figuring out which one, which formula we need to use. So it is going to be that the rearranged one that you can use now. So P naught equals D naught times 1 plus G over KE minus G. So that's the rearrangement of that formula if you want to use that. And if we do that, you end up with D naught is 10 times 1 plus G, which is 3%, over KE, which is 15%, minus 3%. And that will give us our share price. So if we just do that, 10 times 1.03 divided by 12% effective from the bottom, isn't it? And you end up with 85.8 cents. In other words, 86 cents. Which is D. Okay, so that'll give us our P naught, our share price. So yeah, you can use it to value a share. If you know what the company's cost of equity, we can use it to value a share instead. Okay, right. We've then got the next one is about RS. They've got an issue 5% irredeemable debentures, currently quoted at 88 per 100. They pay tax at 20%, and they want us to work out the post-tax cost of debt of these irredeemable bonds. Debentures, bonds, loan notes, all the same thing, so you can use them interchangeably. Now, the fact that they're 5% bonds, that tells you how much interest they're going to pay. That's called a coupon rate, and that will always be based on their nominal value. So nominal value, we always assume is 100. It tells us here anyway. But what that means is we're going to be paying $5 of interest per bond. So we're always going to be 5% of 100 when we're doing this, not 5% of 88. It's not based on the market value. That's the market value there. When it says quoted at, that's the market value. It's always 5% of the nominal value. So the pre-tax yield, if you're an investor, the pre-tax yield, if I'm an investor, I'm getting $5 of interest on a bond that cost me 88. So if you do 5 over 88, you end up with 5.7%. Now that's the pre-tax yield. That's the return to an investor. But they want the post-tax. So what is the cost to the company? So the post-tax, what we then do is take your answer, 5.7%. So this is KD we're working out. times it by 1 minus the tax rate, which is 20%. And instead, you end up with 4.5%, which is B. Now, if you do 5.7% as it actually is times 1 minus 20%, you won't get exactly 4.5. I think you end up with maybe 4.6. But if you just leave it in your calculator, so leave that because that's rounded to 1 decimal place there. If you just leave that in your calculator, then times it by 1 minus 20%, you'll get your the 4.5. So that's fine. Okay, so remember that's the cost to the company. As an investor, I'm getting a 5.7% return, but the cost to the company because of the impact of tax relief is only 4.5%. Right, final question I want to do. It's a convertible debt one. So just to make sure we've covered that off. And let's read the requirement first because it's a bit of a longer one. The value that should be used as the redemption amount in the internal rate of return, the IRR calculation for assessing the cost of a bond. So we're trying to work out, right, what would the amount be in that final year? What would you use as the redemption amount? And they want the answer in dollars to 2 decimal places. So remember, that will be the hire of cash or shares. So when we're doing these redeemable bonds, debentures, you choose the hire of your cash or shares in the final year. So they got 5% convertible bonds with $100 nominal value. Each bond is either redeemable at a premium of 2% or convertible into 15 ordinary shares in 5 years' time. The current share price is $6. And this is going to grow at 4% for the next 5 years. So what we need to do is work out, right, what's going to be worth more, the cash or the shares. So if we look at the cash is going to be a 2% premium, and that's always based on nominal value. So if we take $100 and just increase it by 2%, if we take cash in that final year, we'll get 102. If we take the shares, we're going to get 15 shares, and then says each share is worth $6. Okay, so we might just say, okay, right, we'll just do 15 times 6, see what we get. But they're expected to grow at 4% for the next 5 years. So to do that, what I'm going to do is make it grow by 4% for the next 5 years. So I'll do that to the power of 5. And if we do that, so 1.04 to the power of 5 times by 6 times by 15, we end up with 109.50. And what the company will do, or when we're working this out, we'll always assume that they're going to take the higher of the two. So remember, you've got a choice. Do we want cash or shares? We want the higher of the two. So we are going to go with the shares, please. 109.50. And that therefore would be our answer. To 2 decimal places, our answer would be 109.50. So just be careful with your rounding, as we said earlier. Okay, so hopefully they've been useful just to bring it to life a little bit, the old cost of capital stuff. A few examples, again, maybe the trickier elements of that. It's all about practice, the cost of capital. It's really not, once you know what you're doing, which is easier said than done, isn't it? But once you know what you're doing, they're really not that bad. You just have to see them as lots of little puzzles, I would say, rather than seeing it as one big problem. You get loads of numbers thrown at you, rather than seeing it as, whoa, what am I going to do? It's a bit overwhelming. Just see it as, right, I'm going to start by finding the cost of equity. I know how to do that. I use that little formula. Fine. Now I'm going to move on to the cost of debt. Now I'm going to move on to the cost of preference shares. And if you do it like that and see it as lots of little puzzles, it's fine. It really is. And the more you practice, the better you get at it. But it is absolutely fine in the end. Okay. Right. Hopefully you've found that useful. Best of luck with your studies. I hope it goes well. As I say, keep practicing questions on this, and you'll be absolutely fine. So best of luck with your studies, and thanks for watching.